The CRA has sent a tax bill to a Canadian investor for over $70,000 on money held inside a TFSA, an account that's supposed to be completely tax-free. This wasn't fraud. It wasn't a mistake on the CRA's part. The investor simply didn't know the rules. And if you're using your TFSA the way millions of Canadians do, you might not know them either. Here's what most people get wrong about the TFSA. Tax-free does not mean CRA-free. The Canada Revenue Agency has been quietly and increasingly aggressively auditing TFSA accounts. In this video, we're going to walk through exactly who gets targeted, the four most common triggers that land people in hot water, what the actual penalties look like in dollar terms, and the specific steps you can take today to make sure your account is bulletproof. This is not a scare video. It's a practical one, because the rules are actually pretty manageable once you understand them, but ignoring them can be catastrophic. Let's start with the most common TFSA audit trigger, and honestly, the most preventable one, overcontributions. Every Canadian resident who is 18 or older accumulates TFSA contribution room each year. For 2026, that annual limit is $7,000. And here's the thing. That room accumulates going back to 2009, when the TFSA was first introduced. If you've never contributed, your total available room right now is $109,000. But here's where people get tripped up. The CRA calculates your contribution room based on when you became a Canadian resident and when you turned 18. If you immigrated to Canada, you don't get credit for years before you arrived. And if you withdraw money from your TFSA, that room doesn't come back until January 1st of the following calendar year. So let's say you have $20,000 in your TFSA in October, and you pull it all out to buy a car. You think your room just opened back up, so you recontribute $20,000 in December. Wrong. You've just overcontributed by $20,000 because that recontribution room doesn't reset until the new year. The penalty? 1% per month on the highest excess amount in that month. So that $20,000 overcontribution costs you $200 every single month until it's corrected. That sounds manageable, but people sometimes don't catch these errors for years. We've seen cases where someone racked up $4,000 to $6,000 in penalties on a mistake that would have taken 10 minutes to fix. The CRA does have a process to waive these penalties if you can demonstrate the overcontribution was a genuine error and you corrected it quickly. But you have to apply. It doesn't happen automatically. And CRA approval is not guaranteed. This is the one that catches the most sophisticated investors off guard. And it's the trigger behind that $70,000 audit I mentioned at the top. The TFSA is designed for passive investing. Buying index funds, holding dividend stocks, letting compound interest do its thing. What it is not designed for is running an active trading business inside a tax-sheltered account. Here's the CRA's position. If you are trading frequently enough that it looks like a business, meaning you're buying and selling stocks, options, or other securities on a short-term basis, with the primary goal of generating profit from the trading activity itself, then the CRA can deem that income to be business income. And business income inside a TFSA is fully taxable. Now, there's no magic number of trades that automatically triggers this. The CRA looks at a combination of factors: how frequently you're trading, how long you hold positions, whether you have specialized knowledge or training in securities, whether you're using leverage, and what your stated intention was when you bought the asset. A tax court case from 2021, Ahem v. The Queen, confirmed this interpretation and resulted in the investor owing tax on over $617,000 in trading gains inside his TFSA, gains he assumed were completely sheltered. This doesn't mean you can't be an active investor inside your TFSA, but there's a real line between someone who rebalances their portfolio quarterly and someone who is day trading options contracts on margin. If you're doing the latter, you need to talk to a tax professional, not after you get the audit letter, but right now. Here's a subtler one, and it affects a huge number of Canadian investors who hold U.S. dividend-paying stocks, or ETFs, inside their TFSA. Canada and the United States have a tax treaty that generally exempts RRSP accounts from U.S. withholding tax on dividends and distributions. That's great for your RRSP, but the TFSA is not covered by that treaty, which means when a U.S. company, say, a stock in the S&P 500, pays you a dividend inside your TFSA, the U.S. government withholds 15% of that dividend before it ever hits your account. And unlike in a non-registered account, you cannot claim a foreign tax credit inside your TFSA. That money is just gone. So if you're holding a U.S. dividend ETF yielding 2% annually on a $100,000 TFSA position, you're losing roughly $300 per year to U.S. withholding tax that you'll never get back. Over 20 years with reinvestment, that drag compounds into something much more significant. The solution most financial advisors recommend is to hold your U.S. dividend-paying equities in your RRSP, where the treaty protection applies, and use your TFSA for Canadian equities, growth-focused assets, or bonds. It's a simple rebalancing of where you hold things, not what you hold. Now, does holding U.S. stocks in a TFSA trigger a CRA audit? Not directly, but there's a related issue. If you hold more than 100,000 Canadian dollars in foreign property at any point in a tax year, you're required to file a T1135 Foreign Income Verification Form. Some TFSA holders with large U.S. equity positions aren't aware of this requirement, and failing to file carries penalties of $25 per day, up to $2,500 for a standard failure, and up to $500 per day if the CRA determines it was knowing or negligent. The fourth audit trigger is less common but carries the harshest penalties, so it's worth understanding. Your TFSA is allowed to hold a wide range of investments: publicly traded stocks, ETFs, mutual funds, GICs, bonds, and certain small business shares. What it cannot hold are what the CRA calls prohibited investments or non-qualified investments. Prohibited investments generally include shares of a company where you, or someone related to you, owns 10% or more of the outstanding shares. So if you have a private corporation and you try to hold shares of that corporation inside your TFSA as a tax planning strategy, that's a prohibited investment. Non-qualified investments are a broader category. Things like certain partnership interests, private debt instruments not publicly listed, or cryptocurrency held directly rather than through a publicly traded product like a Bitcoin ETF. The penalties here are severe. Holding a prohibited investment triggers a 50% tax on the fair market value of that investment on the day it became prohibited. And that's not 50% of your gain. That's 50% of the entire value. So if you're holding $50,000 in a prohibited investment inside your TFSA, you owe $25,000 to the CRA. Immediately, non-qualified investments are taxed at 50% while the investment is held, and any income earned from the investment is also taxable. There is some relief available if the investment became prohibited due to circumstances outside your control and you remove it quickly, but again, that requires an application and is not automatic. The practical takeaway: if you're buying anything inside your TFSA that isn't a standard publicly traded security, run it by a tax advisor first. The savings are never worth the risk. So let's bring it all together. The CRA is paying more attention to TFSAs than ever, and the stakes are real. The four biggest triggers are overcontributions, especially from same-year recontributions, active trading that the CRA deems business income, foreign investment tax issues, and missing T1135 filings, and holding prohibited or non-qualified investments. Here's what you should do this week. Log into your CRA My Account and verify your available contribution room. Don't rely on your bank's estimate. Review what you're holding inside your TFSA and confirm everything is a qualified investment. If you hold U.S. dividend stocks, consider whether they'd be better placed